So I have decided to share my knowledge, and this will be beneficial to a lot of people. This is because most people have strategies that have below average win rates, and due to this they use the Martingale money management. And as we all know, the problem with Martingale is that you will eventually hit a streak of losses or consecutive losses that will lead you to blowing your account. So this particular method solves this and reduces the possibility, or for some strategies eliminates the possibility of you ever blowing your account using Martingale. It does this by eliminating the need for you to double or increase your trade size after every loss. So I've selected a random market historically to use for explanation. This is because we don't have time to do it live. So I'm going to use past prices to demonstrate this quickly. We will use a simple strategy for this purpose. If there is a green candle, we call on the next candle. And if there is a red candle, we sell on the next candle. So, for this particular method, we need a spreadsheet, or you can use a pen and piece of paper. So, let's get our spreadsheet. What we need is columns. Here I have 5 columns for demonstration, but if you want to make this strategy more safer or even watertight, you need 10 columns or even more. The more the columns, the safer or watertight this particular method makes your Martingale. But for the purpose of this demonstration, we just use 5 columns. So I'm going to start with a trade size of 1 as an example. And we're going to start somewhere on this chart. We're going to start with this particular green candle as reference. So the next candle should be, on the next trade we should be placing a call because this particular candle is green. As you can see, the next candle was red. So in this particular trade we lost. So we go back to our spreadsheet. We represent a loss with 0 and a win with 1. So for this particular one, that was a loss. So we represent with 0. We don't recover this loss immediately. Instead, we go to our second column B. And we maintain our trade size of 1. For our purposes, we are using $1. This is our reference candle now. So the next candle we should be selling. As you can see, the next candle was green. So again, we go and mark that as a loss. Loss. Again, you can see that we already have 2 consecutive losses. We don't recover this immediately. Instead, we go to column C still with the starting trade size. Our reference candle is now the green candle. So the next candle we are placing a call. And as you can see, the next candle was red. So again, we have a loss. As you can see, we're now going for the 3rd consecutive loss. But with our method, we don't start doubling up immediately. Instead, we go to column D with the same trade size of 1. Our reference candle is now the red candle. So we are selling on the next candle. And as you can see, the next candle was red, so that was a win. Finally, we have a win. So we represent that with 1. Again, then we move to our final column. Again, like I said, the more the columns, the better, but we're going to use 5. We move to our final column with the same trade size of 1. Our reference is the red candle, so we should be selling on the next candle, but the next candle was green, so that's a loss. We represent that with a 0. Now we have gotten to the final column. Now we go again to column A. On column A, we had a loss. Now, this is when we start recovering. In this case here, I would use, most people double their trade amount, but I would recommend double plus 1. In this case, it will be double. That's $2 plus 1. So you go for a trade of $3 on the next trade. Our reference candle being this green candle. The next candle was red, so that's a loss. As you can see, using our method, this is the time now we are getting the 2nd consecutive loss per column. You see? We're reaching the 2nd consecutive loss per column. And now the next thing we do is go to column B. Column B, the first trade on column B was a loss. So we'll be trading $3 on that column. Our reference is this red candle. So the next candle we're going for a put. You can see the next candle was green, so that's a loss. So that's a 0. Go to column C. Column C, our first trade on column C was a loss. So again, $3 on that one. Our reference candle being green, so the next trade should be a call. As you can see, it wasn't a red. It didn't go to the upside, so that's another loss. So we represent this with a 0. Then we go to column D. Column D, we had a win. So this is not a recovery trade. On column D, we continue with a trade size of 1. Not with a trade size of 1, because on that column we had a win. Our reference would be the red candle. So we're expecting the market to go down. It went up, so that's a loss. 0. Then we go to move to column E. On column E, we had a loss. But this is our second loss on column E. So our recovery trade is $3. We're doing double plus 1. So $3 on column E. See what happened there. This is our reference candle. The next candle, we expect the next candle to be up. And it was down, as you can see. So that's another loss. We represent that with a 0. Sorry. I'm going to represent this with a 0. Again, we are done with our columns. We move back to column A. On column A, we have what you'd say is 2 losses. We are on the third step of recovery now. And our previous recovery trade was $3. So double plus 1, that would be 7. So here, we're going for $7. See how that went. Our reference candle is this red candle. So we are going for put on the next candle. The next candle was red, so that's a win. So now we light 1, and we can see that we have now cleared the loss on column A. The loss on column A has cleared. What we do, we move to column B. We had 2 consecutive losses on column B. So we are going for $7 on column B. Our reference is this candle. So we're going for a put. The next candle is red, so that's a win. We show 1. So again, we clear column B. We go to column C. It's still a recovery on the third step, so you're going for $7 on that one. Our reference candle is this one. The next, we place a put on the next candle, and we have a win. So as you can see, we clear column C. Also, we go to column D. We're recovering column D with $7. We go for this is the reference candle, which is red. So the next candle should be the next trade should be a put. As you can see, the next candle was red, so that's a win. So we show that with the win here. That's 1. Again, here we should be going for $7. I think we have exhausted the width of our chart. But anyway, let me show you how this has worked out for us. We have cleared column A, column B, column C, and column D. And if we look at this, the consecutive losses, especially after the trade on the last trade on E, we had first that trade was a loss, second loss, third loss, fourth loss, fifth loss, sixth loss. Depending on the trade amount, initial trade amount, recovering on the sixth or even the fifth trade is that's a very high trade amount. But using columns, we only went up to 2 consecutive losses. Basically, that's the bottom line. We are interfering with the sequence of trades, on the sequence of the recovery trades, and spreading them out. And with this, we eliminate the need for us to martingale or double our account sizes or use a multiplier on the trade sizes during a losing streak. Because what you find is that once your strategy begins not working, you end up having a long period of consecutive losing trades before the market goes your way. And what we need is a method that will ensure that we survive this particular market. And this particular method I've demonstrated here ensures that you do survive the losing streak. And how it does this is by eliminating the need for you to martingale after each loss, and instead go for the fixed trade amount, the initial trade amount, using the columns as below. And again, I will repeat, the more columns you have, the more safer this becomes, because if we had more columns here, we would be probably recovering on the second and not the third trade. So as simple as that. If you didn't understand any of this concept, anything on this concept, you can just chat me up below. Personally, I don't use this particular method because I use strategies that have above average win rate, and we perform well with compounding. But for most people who are using average strategies, or those that have even below average win rate, well, for some people just need to trade randomly. They don't have the time to analyze the market. This is a method of martingale that can ensure you're still winning per session. You can take one session per day, or even 2 sessions per day. And by the end of this session, martingaling, you end up with a profit. This depends on your account size, of course, and the initial trade size. So that's it.